Hello friends, welcome to the Maybe Investor Educational Video Series. How are you doing? I hope you're having great time trading in the markets. So today we have a very useful topic, very important for every trader's life, right? Take a guess, what's the most important thing for every trader's life, or even investors. Investors also, this is very important. That is stop loss. Right? Stop loss, basically to avoid losses. But here we are going to talk about both protective and trailing stop losses. Okay, so I'll explain both the terms what they mean. Right? Okay, so let's straight away, without any delay, go to the details. Alright, so as I said, every trader, this is very important. Even for investors this is important. Investors are little bit misguided by the industry, by the bigger folks, by the guys who just promote investing, right? They are misguided that they just have to buy and don't think about anything else. That's not true. Okay, so stop loss is very important. There are two types of stop losses one should think of. So what I am calling them as protective stop, and here trailing stop. So what is protective stop? Protective stop is basically when you start with a position in the market. Let's say most of the times I'm talking about buying, so and reverse will be true for short sellers also, but just to avoid confusion I'm always talking about buying first, right? So let's say you have bought a stock and you have to protect your position from any immediate losses. That is your protective stop, right? So as soon as you buy the stock, you have something in mind, some level. If the stock breaches on the downside, you will want to come out of your trade. That is your protective stop loss. Trailing stop loss, it is also called progressive stop loss in theoretical terms and technical analysis. Trailing stop loss is about profitable trades. Okay, trades where now you are in profit and you want to protect your profit from being wiped away too much, right? So how you can go behind the price and protect certain portion of the paper profit what you might be seeing at any point of your trade life. Okay, so these are the two types of stop losses. Now the other very important part I just would like to mention here is this point. Professional traders never go down on stop losses. So if I have a buy trade, I am long on something, right? I will never reduce my stop loss. I'll always increase my stop loss based on the price movement, of course, not for no reason. But if I am in profit, if my profit is increasing, I will raise my stop loss, but I will never change my stop loss or go down on my stop loss at any point of time. Please remember this and do not do the mistake of averaging on a falling knife. That's the point. Okay, so but we are not on that topic, so let's move now. What we want to talk about it, what are the different ways, how can you identify the stop losses? I mean, what system you can have so that you are always following it and consistently you are identifying your stop losses at a decent level, which is not eaten up by the volatility, which is not always hit by the smart manipulators in the market. Okay, so there are three ways I'm talking about here. There is first one is ATR indicator. Okay, there is an indicator called ATR, average true range. There is another indicator called PSAR, parabolic stop and reverse indicator, and third one is, it's the name of a method. It's not an indicator, it's name of a method, basing point method. Okay, there is a very elaborate description which you will be able to find in the internet. This is courtesy great book written by Edwards and Maggie on technical analysis. It is very well elaborated there, and they are the guys who have named it basing point method, and it is simply superb if you are looking for, I would say, multi-bagger stocks. People always ask, how do we get multi-bagger? You don't get multi-bagger stocks just because you want it, or just because you have selected a great stock. Also not because you have, identified a huge breakout based your great technical analysis. It doesn't give you multi-bagger returns. It's the way you will manage your trade, and especially this, how you execute your protective and progressive stop losses is going to give you some gift in the form of multi-bagger stocks. So this is, if you have not read it, I would recommend to go and read it, because this one small video is not going to be enough to explain. I will explain very, in very short, but I would recommend people go and read in detail about this basing point method. This has immense potential to give you multi-bagger stocks. So you select a stock based on fundamentals or based on technicals, huge breakouts on long-term charts like weekly chart, and you start getting into profit. How do you trail it? You should be trailing it. You should have a habit of trailing your profits, go behind the increasing stock price, and keep a safe distance. How to keep that safe distance from the current stock price and still not get whipped away by the market volatility is what this method is about. So you can read it in detail, but I would recommend anybody who is looking for riding a multi-bagger journey, this method has to be followed to give you really some multi-bagger stocks, right? So not going into any more theoretical points, straight away let's deep dive into some examples. I will just explain each of these three methods through the examples rather than just in the slide. So let's go back to our charts in our AMI broker. Okay, so I have Reliance in front of me already open, daily chart. Okay, so let's see, the first method is ATR, average true range. How to use average true range. Okay, so this is my price chart. Let me add the indicator ATR. Indicator ATR. Okay, so I've added it, indicator. This is the setting. It will just ask you to set the period for which average true range will be calculated, right? Standard, this tool is showing 20, some tool may be showing 20, 15, 20, it's not going to matter too much. Okay, little bit expert traders can adjust based on the kind of trade they are doing, intraday or positional trade or long-term trade, etc. But I don't care about it too much, so don't bother it. Okay, this is the ATR indicator, which is drawing a line. Basically ATR stands for average true range. What it provides you is the average range of each candle. This chart, average range, how big, how small, average for last 20 period or 15 period, what's the range in which the stock is moving, right? So in a way it's measuring the volatility of this particular instrument. This indicator ATR is a very good way to assess the volatility in a particular stock or any other trading instrument. It's very useful one. Okay, but how to use it for stop loss? There are many uses for this indicator ATR, but I'm going to talk about how to use it for finding the stop loss for a particular stock. Okay, so what you do is, let's say I am buying Reliance here in this gap up, for example. I presume this is for whatever method I have. Based on that, I like this. It's rising, starting with a gap up. So let's say I'm buying somewhere here in this candle zone, right? So what I would do is I will see, let's say my buying price is highest point of this candle, that's 1320. Okay, so my buying price is 1320. 1320 is my buying price. All right, now what I will do is, what's the value of, I will look at it at this point of time when I'm buying it, what's the value of the ATR? That is 80. So this is value of the ATR right now, 80. So average Reliance around this point was moving, average candle movement was around 80 points. Okay, so what I will do is typically 2 times ATR or 3 times ATR value I will keep my stop loss. Okay, so if my buying price is 3 say 1320, right? So and 3 times ATR is something I like, because that especially for swing trades, little bigger trades. Okay, so I would say 80 into 3, that will be 240. So 240 points below my buying price is where my stop loss would be. So that would be 1320 minus 240, 1080. Okay, so my stop loss would be at 1080. Okay, this will be my stop loss. Let me make it in yellow. All right, so I buy here and I will start my stop loss at my protective stop loss. The initial one is my protective stop loss. It will start it here. Okay, now one may ask, why 3 ATR, 3 times ATR only, why not 2 or 4 and all? And that's flexible. I mean, there is no strict rule, market never follows any rule, right? So you have to basically decide based on the what kind of volatile environment this particular instrument is in, what you are trading, right? And also sometimes based on your time frame of trading, your intraday trading or your swing trading. Okay, based on that also you can vary it. All right, so if I know that I am in a quite high volatile stock, so in Reliance I might be fine with the 2 times ATR also, but in a very volatile instrument, or when the times are volatile, I might go for 4 ATR also. So that you have to judge a little bit. If I have to give you a thumb rule for the beginners who don't want to think so much, it's difficult for them to assess, I would say 3 ATR is a decent level at which you can put your protective stop loss. Okay, now this is about ATR. Now second one is the other indicator, that's called parabolic SAR. So let's add parabolic SAR now, PSAR. Yeah, here. Now here you have a couple of configurations which you don't have to touch. Okay, so it's a pretty standard calculation based on standard deviation and whatever formula the originator has defined. We don't need to go deep into the formula, so just don't change any configuration. You will never have to. What it will do is, the moment you add that indicator, you will get these dots above or below the candles, right? So this is straightforward, visibly it's very clear. Okay, so if I bought at this gap up, right, you already know here the level of dot, okay, which is at 1140. So 1320 buying price, at that time it is already saying 1140 is my stop loss, and based on 3 ATR we were little below that. Okay, but the other beautiful thing about this one, so you start at that 1140 level as your stop loss, but here it inbuilt into the indicator, it gives you trailing stop loss facility. Okay, so it is, as you see, it is constantly, if the price is rising, it is constantly rising with the candle. So, and each time the level of the dot is increasing. Okay, so you can say PSAR has its own way to calculate how much distance I want to keep from the current price of this stock, and based on that it is always giving you stop loss. Okay, but the the problem with PSAR sometimes is that it gets into this consolidation zone. It can throw you out easily. Okay, whenever it consolidates for little longer time, okay, even though it is going to go up after that also, it is possible you accidentally get out of this stock, right? So I will talk about finally, before concluding, when to choose. So in what scenarios which method is more useful. Okay, so PSAR is good for highly trending, when the highly trending time, for sprints I would say. So when you want to enjoy the sprints with some kind of trailing mechanism, PSAR is the best. All right, so this is PSAR indicator for your trailing stop, for initial protective stop loss as well as trailing stop loss. Now third one I talk about is the name of the method I said is basing point method, right? Now let me remove this PSAR to avoid any confusion. Okay, even this. All right, now basing point is not going to use any technical indicator. It's not going to be as straightforward as using these ATR or PSAR indicators. This is more around the waves which happen, the up cycle, down cycle, up cycle, down cycle, up cycle, down cycle in the chart. Okay, I would recommend you to read the details in the Edward Magee book for technical analysis about this. You can easily find it in the net. So what you have to do here is, in the basing point method, when you buy, say you buy again here, okay, you have to look for some base below that. It could be some chart pattern based on which breakout has happened, okay, like rectangle or a bullish head and shoulder or a triangle, etc. So if this was a triangle, I'm just saying it's not the triangle here, but if this was a triangle, say, then for triangle, for the pattern itself, there is a basic point where the stop loss should be put in, that is defined in the pattern itself, right? So if there is a pattern, it's very easy. Based on the pattern, you define your initial stop loss. If you are starting just in this kind of a dip, then the lowest point in this chart, okay, the lowest point in this chart you have to identify, that is 875, and below 875 you have to take little bit more distance. Okay, that's the trick. Don't think that I will just take the low of this and this stop loss will not be touched. There are lots of smart guys, and they know people do this. So it is better, and that is the strength of this basing point method, that whatever is the base you identify. So for any non-pattern kind of shape, you identify the lowest point in the chart. You have to take further little bit distance from this lower point. Okay, and again there is a way to define how much distance I should take from that base point, and that can be also differing based on the volatility of different stocks and your time horizon of your trade. Okay, so I'll not go in detail in that one. Okay, so now once you have bought, this is very good for trailing, as I have highlighted, this is the method if you want to get into a multi-bagger stock. So and it's good that we are looking at daily chart, and sometimes you can look at weekly chart also, but I prefer daily chart. Okay, I buy here in this candle, start with based on my base of the pattern or the lowest point, I start with a protective stop loss, and then I start trailing it. Okay, so then I look for the next correction. Now next correction happened here. What's the lowest point in that correction? Here it's 1393. Again take a little safe distance. Let's delete this. Okay, so what's the lowest point here? 1393, and I will take a little bit more, 1%, 1.5%, whatever, and take some distance here and then put it here. So this much gap is required, okay, and let the stock go up, how much ever it wants to go up, all right. And if it goes up again, let it go up when it makes a correction, okay. And let's say this is a decent correction, so then again lowest point here is made after you have seen some candles go up, right, and then you raise your stop loss here with the same gap maintained, right. Now when you read this basing point method, there is a detail provided that once you see the correction and stock starts to go up, what's the exact point after which you should take this as the right basic point, okay. There is a 3-day rule. I will not go in detail, but you can look for that. There's a 3-day rule. Once that 3-day rule is met, then you can consider this correction as your basing point for your stop loss. Same way after this consolidation, I would say, not correction, I can, in this dip, I can move it to here, and if stock never touches my stop loss, I will continue the journey. Someday it might touch my stop loss, I come out, it's okay, okay. And if the stock is looking good based on your technical analysis, you enter it again, don't leave it, okay. So it's possible, you don't get the multi-bagger just in one trade, but if you just keep following the method again and again, it's possible you ended up doing 4 or 5 trades and you get 100%, 200%, 300% returns, okay, provided you follow a little bit of technical analysis and identify a good stock which has broken out on long-term chart, right. They are very difficult to go down too much, okay. And the mistake we are doing is we buy such great stocks, we see some profit, we become too happy and come out of it and forget about it. Don't forget such stocks, keep trailing like this, you will definitely increase your profit amounts you're getting from such great picks, okay. So yeah, so that was our basing point method. Anybody who wants to read more detail about it, the the book from Edward Mackey on technical analysis, you can look for it and read about it. It's very good. I would recommend everybody to read about it, okay. Now in what scenario which one to use? So I already explained basing point I would recommend best for long-term multi-bagger stocks, okay. Now other two, ATR and PSAR. PSAR is good for excellent trending times, okay. When you see spurt happening in intraday or swing trade, you can apply PSAR, but you should be in a very good trend kind of market. Even on a small consolidation, it will throw you out. Sometimes you are okay with it, but it is this should not be used for protective stop. PSAR is better for trailing stop loss. Now ATR, average true range, is good one to start with as a for your protective stop loss. Definitely you can follow that, okay. 3 ATR, 2 times ATR, that you have to decide by yourself based on the volatility of the instrument, but thumb rule, if you want, follow 3x, 3 times ATR, okay. And good one for protective stop loss to start with, and then you can follow, switch to PSAR. I mean, you can do that, you can do a combination also. Sometimes some people can they use this ATR for trailing stop loss also, but for beginners I would say you can use ATR for initiating your protective stop loss and then switch to PSAR if the trend is good, okay, so that you get good pie on the profit. So compared to basing point, these two, ATR and PSAR, are very quantitative. So these are good for algo guys who want to design some algos. They can use ATR or PCR in their algorithm for defining their stop losses. Basing point is, you cannot do it because it's more subjective. You have to look at the chart and define the stop loss based on the corrections, etc. Okay, so if you are kind of an algo guy, then definitely you have to use either ATR or PSAR for protective stop loss, identifying protective stop loss, as well as trailing your profits. Okay, so that is all for today. All right, so I know it's very useful. I just hope that you find it useful. Okay, and start practicing it. Trading is all about being systematic and executing your well-defined, well-proven process again and again and again. So here you have, a system for stop losses. Please follow that. Stop loss is most important part of your trading or investing life. Don't forget it, and I hope you execute this going forward, at least if you are not doing it so far. All right, so that is all for today. Looking forward to talk about something new next time. Till then, goodbye, and wish you a great time in the market. Enjoy your trading. As you know, we publish all our stock ideas on our monthly journal called Stock Snehita. Okay, and you can also visit our website www.mavinvestor.com. Okay, so once again, thank you and have a great time.